Today I'm going to go over the 10 market themes for the fourth quarter of 2024. We'll do a recap of kind of what transpired in the last quarter and then look at kind of the data points and things that we're going to be focused on in the fourth quarter of this year. So to kind of jump into, of course, the legal disclosures, but here are the market themes that we're going to be covering. We'll go over interest rates, kind of what's going on in the stock market, economic trends, look at some of the historical perspectives, and then really the last chart is kind of where I'll spend probably the majority of the time. So let's look at this first chart here. So this is really just year-to-date numbers, the S&P 500 index, and what I did is just kind of put some milestones or some events that occurred so far this year that have occurred. And so you can see like this is when inflation reaccelerated and then we started delaying those first cuts. We had a pretty big sell-off there, and then it just kind of rallied out of it. Number one, because the market started pricing in cuts aggressively again. Here's NVIDIA surpassing the $2 trillion market cap. I remember I don't know, it's probably been 5 or 6 years ago when Apple hit $1 trillion. And I believe it was the first company to hit $1 trillion market cap, and NVIDIA is at $2 trillion just at the beginning of this year. Interest rates hit a peak in 2024, and as you can tell, the markets didn't like that. Get some improvement on inflation, and then here's when we had this global deleveraging. We were looking at, even China. You've heard me talk a lot about China and Japan because their monetary policy is really at a different phase compared to the rest of the world. And then here's where the Fed started cutting rates. So they cut by 50 basis points, which is in line with market expectations, more than what I thought they would do. Really, the market priced it in, but it was like, I just don't see why they would cut 50 basis points so aggressively when the economy is doing so well. And we'll get into that here in just a second. So one thing on, I guess on a positive note, what I put together here is really just a market cap weighted S&P, that's the index that you see on the news and in the media, and then an equal weight S&P 500. And the difference really is a market cap weighted index just means that the larger a company is, the more weight it's going to have in that index. And an equal weight, it doesn't matter the size of the company, they're all just equally weighted across the board. So you can see like about mid-year, well not quite mid-year, at the end of the first quarter, the Mag 7, those big large cap tech companies just skyrocketed, and everything else in the index was really just flat. There was a period there where it was actually almost negative. But now what you can see going into the last quarter, we started seeing the majority of the other companies rising as well, and there wasn't as much upside in those large cap tech companies. You can see that even in like Amazon, NVIDIA, they've still gone up, but not near as much as the rest of the index. And that's good. That's what we call market breadth. And here's just another representation of that. So what I did is just looked at what companies in the S&P 500 are trading above their 100-day moving average. And mid-year, less than half of the companies were. So when you look over here, less than half of the companies were trading above their 100-day moving average, whereas your big large cap tech companies were flying way high above it. So now, from mid-year to now, we've got about almost 80% of the companies trading above their 100-day moving average, which just tells you again that we're starting to see more breadth in the market where the rest of the companies, and this again is just looking at the S&P 500, they're starting to move higher as well. So that could help sustain the markets, even if tech starts coming down. What I did with this chart was really just looked at the Fed funds rate over the last, pretty much going back to 85, but by decade. And so what you can see here is this is the Fed funds rate, and by decade, so for the 80s, the average Fed fund rate was about 10%. In the 90s, it was almost half that. In the 2000s, again, it was about 3% versus 5.3, so not quite half. And then here it went down to darn near zero for the majority. We got an uptick here, but the 2010s has an average Fed funds rate of about 0.6%. And then so far in the 2020s, which we're almost 4 years deep, we're at about 2.4. So the last chart, like I mentioned, that I'll probably spend the majority of the time on, really focuses on this type of information or data. Because what this is showing is the Fed funds rate, or interest rates in general, have just went down for decades. And now we're starting to see an uptick. Now, will that continue? I believe that it will. I don't think we're going to go back to this zero rate unless we have some type of major shock. And it could be, more hurricanes, a war, and a pandemic, or we could have a recession. But again, I don't think that that's going to take inflation and bring it back down to where we were actually trying to get inflation up over the past 20 years. And a lot of that had to do with, the technology from the internet bubble, or the tech bubble in the 2000s. It takes a while for that to feed through, just like this AI boom where, AI is going to revolutionize everything. If you remember back in the late 90s, early 2000s, it was the same rhetoric, right? I mean, the internet's going to change the world, productivity is going to go through the roof. And did it? I would say yes, but it took a long time for that to filter through. And we're seeing the same thing on AI, but things are moving faster, so it may not take near as long before we start seeing productivity increases. But this is really just a depiction that most times when we go through a recession, so you have a recession here, you have a recession here, it takes on average about a 5% decrease in the Fed funds rate to spur economic growth. And since this goes to 1985, if you go back and look at, especially in the 40s, 50s, and 60s, you'll see that same phenomenon where most of the time it's about a 5% decrease. When you have these smaller decreases, which we'll see here in just a minute, a lot of the times that's just trying to fine tune the economy. It's like, yeah, inflation's kind of ticking up. Maybe we will raise rates a little bit to keep that in line. Don't let it overheat the economy. But again, I think, where we're at currently, I think that this average will probably hold through the rest of this decade, that we will see higher rates. And another thing that people need to keep in mind is they hear, they cut rates, interest rates are coming down, but the Fed only cuts the Fed funds rate, which is overnight lending to banks. So it'll impact like CD rates and savings account rates quicker. It'll even impact credit card rates, but what it doesn't really have a huge impact on, and that is mortgage rates. So mortgage rates were coming down. They're at 7%, then they came down to about 5%. They started cutting rates, and the 10-year Treasury is actually up about 30 or 40 basis points. Mortgage rates are now back up above 6%, and that's even here in Oklahoma. So the Fed funds rate does not impact the longer term rates. We call that, down the curve, or, further out on the curve. So I wouldn't expect mortgages to go back down to, 2 or 3%. And like I said, we're seeing the 10-year rate and longer duration bonds move higher. And that's since they cut rates. And what that's telling me is they have such a huge supply of debt because of the large deficit that we're running, that it's going to be hard for them to keep rates lower on the long end of the curve just because of such large deficits. So this chart right here, just how much could they cut by? And again, just going back to 1989, and what I did was I just looked at each time they started a rate cutting cycle, what did the market expect at the time? What was the market pricing in? And how much did they actually cut? So this dark line is what they actually cut, and then the light blue is what the market expected. And so you can see in this, the first part, so these are the 90s. So we had a big boom. This was a tech boom going on. The economy was strong, and we had some blips, especially in 95. But over that time period, the Fed actually cut rates more than what the market expected. And so if the Fed cuts more than what the market expects, then there will be a repricing of assets. And I believe in those situations, that's when you saw asset prices move even higher, because they were like, whoa, we didn't think rates were going to be this low. So when you're discounting back cash flows to value a company, the lower the interest rate, the higher the value will be. So, and you can see that through that entire time period. A lot of the times they cut more than what the market expected, even in the tech bubble, even in the financial crisis. And so right now we're about 1.9% is what the market expects. It's actually a little bit higher than that now because of the jobs numbers that we'll talk about here in just a second. But will they cut this much? And so if history's any guide, it could be a lot worse. And when I say worse, or they could cut a lot more. But I would say that's only if we do go into a recessionary period. So This is kind of where are we at in the economy. So these are just some of the different metrics that we look at. So manufacturing PMI, I went ahead and put a line on here for when the Fed first started cutting rates. So as you can see, as they started cutting, manufacturing PMI came down, and below 50 means we're contracting, above 50 means we're expanding. And so we're definitely have been in contraction since about November of 2022. Housing starts, that's kind of one of those that's common sense, right? Rates went up, housing starts came down. Consumer credit outstanding, this is year over year numbers. Fed starts raising rates, consumers start spending less on things like autos, washer, big ticket items. This is not credit cards. Credit cards are through the roof. But so people just spent less on those big ticket items because of interest rates. And then we've got retail sales here year over year, same thing. People just kind of tightened their belts a little bit more because anything that they were paying, if they went and bought a car or something, it was actually more expensive. So these are just 4 of the metrics, and there's dozens of others that we look at, but those are really impacted by interest rates. And this soft landing versus hard landing. So what I did here was just set it at 0 here whenever they start a tightening cycle. And so if they have a soft landing, then we typically move right on up. I mean, the markets just continue to move just like they have here recently. If we go into a recession, it's typically the next 12 months are typically down. Which way is it going to land? Nobody knows. I mean, I was in the camp of a recession, especially in 20 when unemployment rate went from about 3.5, started climbing up, which we'll talk about that here in just a second, but that's kind of been a little bit more volatile than in history. So, and this is that chart that'll kind of explain that. So job openings, this right here is job availability, here's unemployment, and this is wages and earnings growth. So job openings, super strong. We're at 7.7 million job openings. This gray line is the 30-year average. The light blue line is pre-COVID. So you can see we're really strong here, have a lot of job openings. The quit rate is about normal on a 30-year average, and even on pre-COVID, we're about back to where we were, or actually even a little bit better on the quit rate. But these 2 I should have updated because this changed yesterday, and I'd already built these slides. So non-farm payrolls, 142 is what was expected for last month. It came in at 253, so way higher. I'd put this up here in the strong, but these non-farm payrolls are pretty volatile on a month-over-month basis, and it's 1 data point, so we're not going to let that, really sway us in either direction. But it's no longer weakening, and we've had a couple of those that came in way stronger. The unemployment rate says it's weakening, but that number actually came in at 4.1. It was 4.3 the month before, then it went down to 4.2, and then this last month it was at 4.1. So again, it's actually coming back down, which means the economy's strengthening, and a lot of this stuff will filter in, and it has pretty long lags. And continuing jobless claims. So this is, once someone's let go and they try to find a job, how long is it taking them to get a job? So these are continuing to claim, and we're pretty normal there, especially pre-COVID. It's a lot higher on a 30-year average. And then wage growth is really strong. I mean, 3.8%, 2.8% over the last 30 years. Pre-COVID was at 3, so at 3.8, it's really a strong number on earnings growth. But you have to remember, and if you watch some other of the market memos or read any of the commentary, whenever I'm talking about wages, inflation really is driven by wage growth minus productivity growth. So it's kind of just logical to think about it. If you make more money and you produce the same amount of whatever you're producing, then the price of whatever you're producing should go up, because there's, again, more money chasing the same amount of goods. So what we'll need to see here to keep inflation at bay, if wage growth continues, is productivity actually increasing as well, which we have seen. So that's another positive sign. This is just you can scrub the web now, or the earnings calls. So in Bloomberg, you can type in a keyword like I did here, which was recession, and see how many of the S&P 500 companies are mentioning that. And that'll give you just kind of a very baseline sentiment analysis, right? Like, this is kind of what these companies are mentioning what they're thinking. And a lot of times, they see it right on the front line. So this shows, here's 2020. At the second quarter of 2022, you had about the same amount of mentions. That didn't come to fruition. And as the quarters went on, less and less of these CFOs and CEOs were talking about recession, which again is a positive sign that we could be entering the soft landing zone. That's yet to be seen. When they cut rates 50 basis points, it's going to take 12 months or more before that filters in throughout the economy. So we'll see if they're seeing something that we're not. If you read the memo from last week, I wrote about a page on this topic right here, but this is just a graphic, and I get a lot of questions, like, well, what happens if so-and-so becomes president? What do you think? And this chart just kind of summarizes it all. This is going back to the 1950s, and this shows what you would have returned if you would have only invested when a Democrat was president. The red line is what you would have earned if you only invested when a Republican was president. This gray line is if you didn't care and just stayed invested, going back to 1950. And they didn't put, a logarithmic scale here, but if it was, it wouldn't be such a steep deal. You'd actually see it going a little bit more smooth. But again, the politicians don't have a huge impact on near-term economic, whether we do well in an economic environment or not. Their policies, physical policies, what we see where we just build up large amounts of debt over time. So they're all to blame in that sense, So the one thing that drives the markets and the economy is really Jerome Powell now. He's the Fed chairman. So the Federal Reserve, the central bank, is really what drives the economy. And so in reality, when a president becomes president, it really just depends on when they come in the cycle, what the Fed's doing. I mean, now they're easing, so whoever comes into president now, if we don't have a recession, they ease enough, you'll see a boom in the economy, and they just get credit for it. But in reality, the president has very little to do. Half the time, what they get out there and get on their soapbox about, the policies that they're going to implement, they don't come to fruition, right? They get stuck in Congress, or they don't get passed, or they get diluted. So again, it's monetary policy is the driver of the economy. And this is the last chart that I want to talk about. I'll try not to spend too much time on it, but when it comes to portfolio management, a lot of the times, there's just a lot of believable misinformation out there. There's a lot of theories that are out there that they're great in theory, but in reality, they don't work because of the assumptions that are a part of them. So, for example, modern portfolio theory, long-term, what that really, just think of it as what you hear is diversification, right? It's you don't want to put all your eggs in one basket, and diversification is dependent on the correlation between the assets that you put in your portfolio. And correlation just means if they're positively correlated, then when this asset goes up, so does this one. If they're negatively correlated, when this asset goes up, this one goes down. And if they're non-correlated, if this asset goes up, this one can go up or down. It's independent of the other. And in modern portfolio theory, it's just buy a bunch, buy US, international, large cap, small caps, bonds, treasury bonds, corporate bonds, high yield bonds, put those in a portfolio and you are diversified. But in reality, it depends on the correlation. If I put in US small caps, but they're highly correlated to US mid caps, then the diversification benefit is lost. If they're perfectly positively correlated, then you only need one. Because if this one goes up, so is this one. So you might as well have just bought one asset and just put whatever amount or percentage of your portfolio, just add it to this one. But the problem with that is correlations aren't stable. And that is one of the assumptions in modern portfolio theory, is that correlations between asset classes are stable through time, which means the number one is stocks and bonds, right? So if stocks and bonds are non-correlated or negatively correlated assets, and that's stable through time, then it will work through time. Because if I buy stocks and bonds on this ratio, then I can expect this. But in reality, this is going back to 1995, And you can see in the late 90s, stocks and bonds were both correlated. This is what this chart is really just looking at the stock to bond correlation. And I had to put it on a 24-month rolling period. What I like to look at is 12-month, but then it's a lot more volatile than that. So this just kind of smooths out, but the whole point of it is to show that over time, stocks and bonds become positively and negatively correlated, and it really depends on the economic environment. When you're in, for example, the easy one now, I mean, when I was saying this before 2022 and showing, like, look, this is in the 40s, 50s, 60s, even in the 90s, this occurred. It hadn't happened in so long that you've got this 20-some year window here towards it's like, 60-40, stock to bond ratio, and I'm good. And it's like, yeah, but if they become positively correlated, no matter how conservative you think your portfolio is, it's likely going to be more risky. And so this is just a perfect point here. But when you have stocks and bonds positively correlated, same thing happened here. It actually started in 2021, but 2022 is another perfect example. It didn't matter if you owned stocks or bonds, they both went down. And depending on the duration of the bond portfolio that you were holding, it could have went down a lot more. If you look at long-term treasury bonds during that time period, I know at one point they were down 40-some%, and the stock market was down 20% in 2022. But a conservative investor that had more bonds than stocks, thinking that they were less risky, in reality they were just as risky because the economic environment shifted, and now we were in an inflationary environment, which means they're going to raise rates, and raising rates isn't good for asset prices of companies. So they both went down together. The only thing that held true during that time, because we were in inflation, and what does well in inflationary environments, and that's commodities. So again, this is just to show that economic theory, modern portfolio theory, when there's assumptions that don't hold true, even though they may hold true over long stretches of time, you really have to pay attention when it comes to portfolio management. What economic environment are we in, and what economic environment are we headed into? And the unfortunate thing is that's all based on probability, right? Because the future's uncertain and you don't know what's going to happen. Even though everything looks to be in one trajectory, all it takes is an outside shock or the Fed to do something that the market wasn't expecting, and then asset prices will readjust. And most of the time, these big swings or these paradigm shifts in economic environments occur over long periods of time. So they're not easy to spot initially. It's in hindsight, you can look back just like this. I mean, it's easy in hindsight to go, this is what happened. Look at that, stocks and bonds. This is a perfect time to own a 60-40 portfolio and do really well, even in recessionary environments, because the correlation between them was actually negative, and it would bounce, become less negatively correlated, which means they moved a little bit less volatile. The spread was less, I guess would be the easiest thing to say. But you can only see that in hindsight. We're here. So which way do you think it's going to go? Do you think it's going to go back down negative? Do you think it's just going to slightly come down and we're going to be jumbled around here? There's really no way to know. You can look at economic data points and then build, I guess what you would call your probability matrix on what you think would happen. If this happens, then this will likely happen. And so then you just monitor those economic indicators. So that's it for the 10 market themes. If you have any questions, feel free to reach out. And you can just reach out by phone or email. And this link isn't going to work on watching the video, but if you'd like to schedule an appointment and you want to just do that online, you can go to our website, just click Let's Talk, and it'll pull up the calendar, see what we have available, and then you can schedule that way. But I hope that helped out to kind of let you understand what we're looking at. But until next time, guys, choose your advisors wisely. Your financial health depends on it.